come in from names like Cipla, there's Tata Consumer Products, HDFC Bank, but let's see how it goes. For now, absolutely quiet opening for the market. The Nifty is down about 20 odd points. The mid-cap index is up about 70 points, so it's better performance for the mid-cap index this morning. And the Bank Nifty once again dragging its feet down about 60 odd points. What's doing well? Asian Paints is up about 1%. NTPC, Adani Enterprises, Bajaj Finance, BPCL, Coal India are all in the green at the moment. And on the losing end, you have, as I mentioned, Cipla, Tata Consumer, Bajaj Auto, Hindalco, Grasim, Nestle are a couple of stocks that are on the losing side. In fact, just a little bit of profit taking as well in names like Cipla, Divi's Labs, etc. that are a tad bit in the red. Otherwise, you'd have to say it's a very, very quiet opening. Nothing alarming either way. Adani Power is in the green, so we'll keep our eye out on that. And something like a Lupin continues to hit fresh 52-week high. So just pull up the Lupin stock, 2.5% higher now. That stock is up almost about 55% this year. Ekta was telling us about the Spiriva generic launch approval, so that is looking pretty good. And a couple of other names as well in terms of, since we're talking 52-week highs, names like Trent, etc. sitting. Suven Pharma is at a fresh 52-week high. So a lot of stocks over there. But otherwise, it is a quiet opening. The Bank Nifty is now in flat territory. The Nifty as well. So just buying time, I guess.
Well, that's right. So a couple of large trades is what we saw yesterday. JSW Energy for the month itself, it's up close to around 25%. Yesterday, you had GQG going in there and chipping in yet again. Remember, they bought in Monday, they bought on Wednesday as well. Today, its stock is cooling down a little bit, pulled back close to around 2%. Adani Power, well, that one was higher, one of the large volume movers today. So that stock should come up for you on the screen. Abhishek told us about that brokerage note on Shriram Finance. Well, the street is taking note of that. Stock is up close to around 2.5% as we speak. Hindustan Copper, yesterday it pulled back big time because of weak numbers and valuations as well. That stock, in fact, is pulling back higher in today's trading session. More or less, it's a quietish start. Though from the broader markets, I think a couple of stocks. Global Spirits is down close to around 3%. That block deal, I think, needs to take place out there. So that stock is down 3% odd. And Nava Limited as well is down close to around 3.5%. Prashant, what else?
Well, IRFC is down 4%. It's the largest volume traded name right now, just under 50 odd rupees. Suzlon, we spoke with the management yesterday. That is coming up at number 2, just under 20 rupees there on Suzlon. So that's IRFC and Suzlon on the downside. We've got Indian Overseas Bank, which has been on a tear last 2 days. That is pulling back about 1.25% or so. And what else? L&T Mindtree is down about 0.75%. Moripun Laboratories is down a little bit. Bombay Dyeing is down about 1%. So this is largely quiet. I mean, it's not really a big kind of start. I was just talking about the shipbuilders, right? Anand was commenting on that as well. Look at Cochin Shipyard, 5.5%. It's the number 1 volume traded stock in the market as we start. So Cochin is up 6% now, actually, 853. And then the number 2 is another shipbuilder, Garden Reach. That's another 5% this morning, and on huge volumes for this point in the day. So third day running, the move continues in these shipbuilders, not broad defense. It's not HAL and others. This is shipbuilders specifically. Mazgaon, of course, is the best performer of the lot, and I guess the other two, Cochin and Garden Reach, is just catching up to what Mazgaon has already done. Indiabulls Housing Finance was up 5 or 6% yesterday. That's up another 2% this morning. We've got Uno Minda, which is up about 3.5%. Shriram Finance we highlighted. HBL Power has been moving up consistently. I mean, there's no correction here. It's, I think, a new high. It's up another 3% this morning, HBL Power. We've got, HG Infra and 63 Moons and Texmo Pipes. Texmo Pipes saw a very large move yesterday, and it's up strongly this morning as well. So this is looking pretty good. I mean, actually from 60 bucks, this one, Texmo Pipes has moved up to almost 90 in 3 or 4 days flat. So it's been tremendous in terms of the move that we've seen here. Market breadth is positive, not quite 3:1, but close. So nothing to really complain. We got 100-point dips last 2 days, and then progressively the market got better intraday. Today, I mean, the dip itself is not large at all. We're already down just about 20 points or so, 19,440 in good shape. Pratik Gupta is Chief Executive Officer and Co-Head at Kotak Institutional Equities. Pratik, good to have you with us here. Thank you very much for your time. We had Jahangir Aziz, JP Morgan, who looks at emerging markets, India, etc., from the economy point of view. And his broad point was that US and emerging markets are doing just fine. I mean, you're at a point where perhaps you got to ignore what's happening in China and Europe. So he says this country-wise emerging market economies are all raising their country growth forecasts, even with all that is happening around the world. So it seemed to be just fine, Prateek. The problem, though, is valuations, isn't it? How comfortable are you, and what are we really pricing in here now with what the market has done?
Hi, good morning, Prashant. I think you hit the nail on the head, and this is what we are hearing at Kotak from our discussions with global investors as well, that from a top-down perspective, India looks quite attractive. The longer-term outlook is very, very good. There are very few large emerging markets in the world where you can see GDP growth north of 6% for the next 10, 15 years. And the macro outlook is also looking stable, whether it's the current account deficit, the fiscal situation, inflation. Yeah, it's gone up a little bit right now, but hopefully this is a temporary phenomenon and it will come down. So overall, top-down looks fantastic. The problem is bottom-up. So when we speak to our clients globally, they want to invest in India, but when it gets down to stock picking or investing in particular sectors, that's where we run into issues with most of them complaining that valuations are indeed quite high. If you look at the Nifty, for example, we're now trading at 21 times FY24 PE, about 18 times FY25 PE for earnings growth of barely about 15% on a price to book basis is about 3 times for about 15% ROE. If you look at India's premium versus other the MSCI EM index, we're now at a premium of about 60%, which is more or less in the middle of the range. It's historically ranged between 40 to 80, 90%. So India's not sort of cheap by any stretch of the imagination. At the same time, the longer-term outlook is very, very attractive still, and we also remain quite positive from a long-term perspective. But the problem is, I think in the short term, we will most likely go through a consolidation phase because of the expensive valuations, both at the broader market level as well as at the individual stocks level. One thing I can tell you is we don't expect a very large correction. We believe there's a lot of money waiting on the sidelines, both foreign money as well as local money. If the market were to correct more than, let's say, 3 to 5%, we think a lot of money will come into the market and support the market. But equally, in the short term, next few months, we don't see a big rally either. So we think, unfortunately, we're going to be stuck in this boring zone, plus minus 4-5% for the rest of this year.
Okay. Well, Pratik, hi, good morning, and thanks for joining in. I just want to point out to our viewers that, this whole electric vehicle, this bunch of stocks continue to rally. So whether it's JBM Auto, just want to get them up on the screen, JBM Auto, there's Electra Green Tech, there's Tata Motors, Ashok Leyland. So the street is clearly very, very excited about the potential of this large scheme for electric vehicle buses across the country. And there's follow-on buying there. Pratik, good morning. So since the market is going to be a bit boring, let's talk about individual sectors, right? Top of mind is this space, electrification of vehicles. And a lot of people believe that despite the 50-60% rally, this is a structural up move that could go on for years. Are you in that camp as well? And what should investors do here?
Yes, you're right. We agree with the structural story. And I think the more important thing over here is to first look at some of the incumbents. This is actually because of this theme, this risk of disruption for the incumbents. We have been somewhat cautious to depending on the stock, often negative on some of the incumbents in the two-wheeler space in particular, where we think the disruption will be the biggest. But equally, as you rightly pointed out, we think there will be opportunities for the auto ancillaries who are involved with the EV space, and those who have good products, good design technology, good manufacturing capabilities. The only issue over there, however, is in the short term, you may run into 1 or 2 quarters of somewhat weakish demand. The world is slowing down. Decision making is getting elongated, and I think more importantly, valuations have gone up again. These stocks are not cheap by any stretch of the imagination anymore. So you'll have to, again, even with these stocks, you've got to have a 3 to 5 year sort of investment horizon to be investing in these stocks right now. But longer term, yes, we agree with the EV theme. We think these are great businesses. But equally also watch out for the disruption risk for the incumbents, some of whom you may see some negative earnings surprises over there in the coming quarters.
Hi, Prateek. Good morning. Nigel on this side. Prateek, what about the IT space? How are you all positioned out there? Global economies are likely to slow down in the second half of this year. And there's, some of these numbers are pretty ordinary. But yet some of these stocks are holding up. Maybe, they continue to find preference. How do you approach these stocks? I mean, will it be a place to hide? If you have a longer time horizon, do you think that it's a good time to chip into some of these IT names, or would you stay away?
Nigel, hi. On IT, I think it's still a bit too early in our view. One of the reasons why these stocks have done well is because the US inflation data has come in softer than expected, raising hopes that the US may achieve a soft landing. And frankly, the jury's still out on that. So it's still a bit too early. We are still continuing to see a slowdown in discretionary spending, and especially in IT companies which are focused on the BFSI and the telecom space in particular. We think there is a risk of further earnings downgrades in the coming quarters. And the next 2 quarters, we don't see scope for much earnings upgrades. So over there also, we think given where valuations are, we're going to be range bound. But yes, the longer term outlook on a 3-year kind of view, it still looks attractive. I think the Indian outsourcing story will only continue to improve. And also globally, we are seeing more and more of the cloud migration, a lot of apps being built for that, a lot of software development requirements for that. So that story continues. The other way to play it is also focus more on the large cap IT names, which are less vulnerable to a slowdown in discretionary spending versus the mid caps, where the client concentration risk is a lot higher, where the product, the service lines are not as diverse as you have in the large cap names. And the large caps tend to weather a downturn or slowdown much better. So, and given where valuations are, where some of the mid caps are still trading at par or above the large cap names, our preference would be on the lookout for small corrections, which we expect over the next few months, and buy into the large cap names.
Prateek, you guys are also, Kotak is also one of the largest players on the investment banking side, on ECM, the equity capital market side as well. And transactions are through the roof. Promoters are selling, private equity is selling, but you've got enough buyers on the other side as well. What's the broad kind of thinking within the team at Kotak? In terms of how you're looking at all of this activity? The general kind of refrain is, well, insiders seem to be selling, so it can't be good. But I'm assuming it's not really that clean, right? I mean, shades of grey. So tell us.
And you're right. We don't think just because a PE or a promoter is selling, it's necessarily bad news for investors in the long term. There have been numerous instances over the last 5-10 years where promoters or PEs have sold out and the stocks have gone on to do really well. A lot of the IPOs which have come out in the last 2-3 years, they were mainly PE exits, and some of them have done quite well. But I think there is a broader question, and that's a broader concern, and that's what's goes back to our view that the markets will stay range bound. Is this paper supply which is likely to come through both in the form of IPOs as well as blocks? Now that the earnings season is over, when most of these companies and these insiders are out of their quiet period, out of their sort of locked up period, etc., you will start seeing supply coming out, and in the next 45 days. You could see a lot of supply hitting the market. But equally, like I said in the beginning, we do have global investors as well as local investors who are eyeing the market, looking for stock-specific opportunities where there might be a little bit of a discount. And remember, a lot of these global investors also worry about liquidity, because if they're buying, let's say $20 million, $50 million, $100 million of a stock, it straight away tends to have an impact on the stock price. The price shoots up. So when you get a block, that's an opportunity for them to deploy capital. So to that extent, we think a lot of these activities will go through. We at Kotak are definitely seeing a lot of inquiries, a lot of activity on our side. We think it's going to be quite a busy next 40-45 days. So let's see how things pan out. But overall, I don't see the market still correcting too much because of this paper supply, because the underlying demand is still out there.
Okay, all right, Prateek, appreciate you stopping by and filling us in with your take on the market. So maybe a little bit boring on the headline, maybe a 4-5% move either which direction, but plenty to talk about with regard to the broader markets. Look forward to chatting up with you rather soon. For the time being, though, let's turn our attention to Honeywell. Well, they reported a mixed set of numbers, good growth on the top line, though margins were a little bit under pressure. To discuss what happened in the past quarter, and more importantly, what's the way ahead, we're joined by Mr. Ashish Gaikwad, the Managing Director of the company. Hi, Mr. Gaikwad. Good to speak to you as always. Well, your gross margins were maintained, which is a positive. Close to around 47, 48%. It's been in that vicinity. However, the EBITDA margins got diluted because other expenditure spiked up. So explain to us what went on with that other expenditure. That's the reason why the EBITDA margins did see a miss.
First of all, very good morning to you and all your panelists. Nigel, let's look at the good things first. As you mentioned, we had reasonably good gross margins. Also, if you look at the order book, it is about 41% higher than the previous quarter of the previous year, right? And so we are looking at the growth that is coming in, which is building the backlog. The revenues also have gone upwards of 18.5%. So I think that's going well. And that gives us the backlog to burn over the next few quarters. And lastly, the earnings per share, they went up as well. So that's a good part of the story. You are right that there have been some pressures on the margin. I don't want to get into the other costs that have come in, but essentially this is about three factors that are affecting our margins right now. So the first one is, of course, the competitive market. The domestic market is growing in India compared to the stable exports market. And therefore, that puts pressure on the pricing when we compete. The second is about our long cycle businesses, the projects businesses, where we take fixed price contracts, most of them. And therefore, when there is inflation and the input prices go up, then that affects the overall margin. And the third one, I would say, is there were some one-timers that came in and we had to deal with those. So that has kind of impacted overall margins.
Okay, all right. Mr. Gaikwad, just to confirm that number, the order intake is up by close to around 40% on a year-on-year basis.
Yes.
Is that correct?
That is correct. Absolutely.
Oh, so you're well placed then for growth from year on. I just wanted to further dissect the revenue number. A couple of years in the middle, the export contribution went down, which in turn put pressure on margins. Now that perked up back to above that 1,400 crores for the past year. For this year, what kind of a contribution are you expecting from exports? And for the exports part of business, what kind of growth should we look at? Mid-single digit? Should we look at a double-digit growth?
Yeah, that's a question that you have always asked, Nigel, when you look at Honeywell. So first of all, when you divide the pie into exports and domestic, right now the growth in the domestic market is really good, and we must make sure that we participate in that growth in the Indian market. So when we do that, certainly exports, the overall size of the exports pie starts to look a little lower compared to what it used to be. Right now, when you look at our last year's performance, FY23, it's about 41% on exports and remaining on the domestic side, which was, in terms of absolute numbers, about 1,400, slightly above 1,400 crores. When I look at our exports business, this is not just a few countries. We are very much spread diversely around various regions, North America, Latin America, Asia, Middle East. So, sorry, go ahead.
No, we got that. For the paucity of time, I just wanted to get a couple of more numbers out of you, Mr. Gaikwad. Good morning and thanks for joining in. I wanted a view on margins because the operational performance has been deteriorating if you look at it both sequentially as well as on a year-on-year basis, right? In Q1, your margins are now sub 13%, but you used to at one point in time enjoy even 16, 17% margins. Just trying to understand what is the expectation as we move along. Is there more pressure there on the operational front?
Morning, Sonia. Yes, I think there is pressure. And by the way, we are at about 15% odd PBT and about 11 on the PAT. And, that's a reflection of the margins, the question that you asked. We believe that we will have performances in that range in the time to come. And of course, we will try to find a better mix whenever there are opportunities. But I think that we are still in the leading group of the pack in the industries when it comes to margins.
So when you say that, you're in the leading group as far as, compared to the industry when it comes to margins, but what is your own range? I mean, what are you looking at? Do you think it would be in this 12 to 14% band? And in the domestic, margins are seeing a bit of a drag as well. So what is the expectation there over the longer term?
So our business model is such that we have to create the installed base. And therefore, when the growth is happening, we have to win the projects so that we can go later on and then add on top of it, provide lifecycle services. So till the time the growth happens, we would like to participate in building our installed base. And therefore, we would be in the same margin range that you see for some foreseeable time.
Right. So at around current margins is what you'll maintain, mid-teens odd.
Yeah, hard to speculate right now. I won't want to do that. Okay. But yeah, I think that's what I would.
Mr. Goyakad, I just want two numbers in terms of growth, because as you're indicating, the India story is, very much alive and kicking. And, that's where growth is going to come from as well. So, when you joined us the last time, you said maybe you'll grow at 2 times what India grows at. So we were just trying to extrapolate that. And I think the number we came to was early teens, 1.5 to around 2 times odd. Now, given the kind of start that you've had, do you want to revise that? Can we see growth in this year, that is FY24 for Honeywell as a company consolidated entity, grow by close to around maybe late teens? Is that possible? And just some clarity on that exports number. Last year it was 1,400 crores. This year you said how much will it go to?
I did not say anything about the next, coming year, right? I just said that last year it was 1,400 crores plus.
Yes.
And we would be, growing at the world's economic growth rate, and domestic growth is higher. Therefore, we'll see the domestic business sort of growing faster than the exports.
Okay, but for the company, you were targeting growing 2x the GDP.
Coming back.
Please go ahead.
Coming back to that point, as you can see that we are increasing our order books, the 41% that I mentioned to you earlier. Also, if you see the last year's growth, we talked about 18.5% revenue growth. And so, depending on the mix, because we do have short cycle and long cycle businesses, as I've explained to you earlier, we would turn some of that revenue in the backlog in a longer term. So we would still believe that our growth rates, we would absolutely try to achieve 2 times that of GDP. That would be our ambition. But it depends on quarter-to-quarter mix of the business.
Okay. I wanted your thoughts also, to look slightly far out on the renewable energy market as well. What is the kind of traction that you're seeing there? What are the new orders in the renewable energy market? Any clarity that you can give us?
Certainly. I think there are 2 mega trends on which we are continuously working on: the industrial digitalization and automation, and sustainability in the industries. And so on the sustainability side, as far as our play is concerned, it starts from providing automation to the gigafactories. There are multiple battery manufacturing facilities being talked about. We also play in the automation of electrolyzers, which are coming up in a large quantity in the time to come. We also have automation that goes into the renewable fuels like ethanol. Ethanol is coming up in a big way as a part of blending into gasoline or petrol. So I think we have a play there. We also are in the business of providing what is called as battery energy storage system, which is juxtaposed to the solar plant. So all of that sector, which I mentioned to you, and I heard you guys talking about the EVs that is a hot topic today. We provide sensors that will protect the batteries from heating up, and therefore a battery safety system that we provide. It's a small part of the whole system, but certainly that's good news.
All right, Mr. Gaikwad, very quickly, the former president of Microsoft India has joined Honeywell India. I think Anand Maheshwari. Does he have a role to play in the listed entity as well? Is there any kind of strategy change?
So Nigel, just a correction. Anant Maheshwari is a colleague, ex-colleague, and now comes back to Honeywell again. His role is that he's the president of high growth regions in Honeywell. It's a global role. He has the responsibility for China, India, Latin America, Middle East, Eastern Europe, etc. Right? So he has a much larger role to play, but he does not have a direct role in Honeywell Automation, the entity that we are talking about, and we will collaborate. Of course, we will collaborate and work together as he joins us.
Okay.
Okay, all right. All the best, and thanks a lot for joining in and giving us a lot of details about the business. That's Honeywell Auto saying they aim to grow at 2 times that of India's GDP, and they're very optimistic on the mega trends, which is digitization and sustainability. Okay, those seem to be the buzzwords, and Honeywell is sort of making the most of that. Let's slip into a quick break. On the other side of the break, we have Ashok Kumar Tyagi, the managing director at DLF, to discuss demand trends in the industry and the outlook for the company. We'll also have G.N. Gupta, the former executive director at SEBI and managing director at Stakeholders Empowerment Services, and Abhishek Dadu, partner at Khaitan & Co, to discuss SEBI's decision to review delisting norms. Hi, welcome back. This is Corporate Radar, and on our radar right now is realty major DLF. They are re-entering into the Mumbai property market with an SRA project in Andheri of 2.5 million square feet. Do note the company has also managed to reduce its debt. It's now at the lowest level in several years. That's actually been the focal point for the company to deleverage its balance sheet, and the street is like that. To discuss business opportunities and demand trends, we're joined by Ashok Kumar Tyagi, the managing director at DLF. Mr. Tyagi, good morning, and thanks a lot for joining in. Before I ask you about all of these plans with respect to the residential business, the move in Mumbai, etc., I just want to understand that recently the promoter entity sold a bit of stake. I wanted to know what the reasons for that are, and is there any plans to sell more stake in future?
Okay. So, good morning, Sonia. The promoter entity, all the promoters put together owned about just, short of 75%, which is the maximum public float. KP Singh, who is the chairman emeritus of the company, and in that sense, who's sort of been the guiding light of the company for the last 50 odd years, had a small stake of about 0.7%, which he sold off for about 750-800 crores. And predominantly at the stage of life that he is in, he wants to, set up a charitable foundation and use this money as the corpus for that. So that was really the primary driver for the stake sale, the way we understand it. I don't think that there is any move by any of the other promoter families by any of the other promoter groups to liquidate their stock further. But yes, this was, I think, a one-off, predominantly driven by the chairman emeritus's, vision for setting up a charitable foundation now.
Okay, so you're confirming, or rather assuring investors, that this was a one-time thing and there would be no more big stake sales by the promoters. Is that fair to assume?
At least not in the short term, for sure. I can't give you a 20-year guarantee, but yes.
Sure, of course. No one can give a guarantee for about anything, right, in the next 20 years.
That's
but
fair.
Another thing I wanted to check with you.
And also I wanted to sort of reassure you further that that our chairman, Rajiv Singh, who owns the bulk of the promoter stake, not a single share from him was sold.
Okay. So not a single share from Rajiv Singh was sold. Got that. And that's important, actually. It's an important clarification. So thank you for that. I also wanted to understand the REITs listing, right? And we've spoken about this at length. What is the timeline in terms of the listing of the REITs in your portfolio?
Okay. So, Sonia, we began the REIT preparation work about 2 years back, as we had disclosed at that time, with a reasonable degree of enthusiasm in conjunction with GIC. I mean, 2 years, obviously, a lot has changed. The COVID, induced a lot of uncertainty in the office market, which led to higher vacancies. Then the higher interest rate regime kicked in. So, I mean, the sort of, the current listing performance of the listed REITs in India has not been very great. So obviously, we are ready in that sense from a listing standpoint. We had certain restructuring and mergers, etc., to be done, which are now all underway. So there are no structural, speed breakers to the REITing process. But I think the REIT will happen driven by two factors: A, as in when the interest rate regime and the overall markets improve, and B, frankly, to a large degree, it will be driven by when GIC wants a roadmap for at least, either a mark to market or a potential exit for their investment in cybersecurity. And frankly, I mean, I don't think that either of them is going to happen in the short term. But yes, we are REIT ready. We continue to be REIT ready. But I do not think that the REIT is happening in the immediate short term.
Okay, not in the immediate short term. And it'll also, an important indication will be when GIC wants to, as you said, mark to market. Got it. Mr. Tyagi, good morning. Prashant here.
Sorry, Prashant, just to clarify further.
Yeah.
I mean, I would not be wrong in saying that for us, the primary driver of the REIT will be GIC's desire, because we as DLF, frankly, do not believe that that it will be a hugely like value accretive thing for us. Neither are we looking at divesting our own stake in cybersecurity.
Yeah.
So, but obviously, as a responsible partner to GIC, as and when GIC does decide that now is the good time to sort of go to the market, we'll support all those efforts.
No, that's understandable. And thanks for that. Mr. Tyagi, you also said as one of the conditions, if as and when market improves, I mean, market is has been an improved state for some time.
The market is not the stock market. So if you look at the interest rates today,
I'm saying I don't mean the stock market. I mean property markets. I mean, I remember last time when we spoke. Yeah, I mean, and so even with interest rates where they are, and things are looking pretty good. So I just want you to kind of tell us, since the last time we spoke, how things been. How's the high-end segment doing? I remember you told us in the Camellia project you had some 40 units left. This is during our last chat. All of them gone.
No, not all of them gone, but yeah. So Camellia continues to obviously sell at a fairly high clip. There are, I think, now maybe about 30 odd units left. I think they're selling at about 8 to 10 units a quarter. The sales performance, I think, across the board, from the more moderately priced end products in the farther sectors of Gurgaon or Panchkula to the luxury and the super luxury segments like Camellias. I mean, it's been across the board enthusiastic response, which continues. To some degree, our success in Arbor in Q4, where we, as you know, we sold almost 8,000 crores of apartments within the quarter, did mean that for the first 2 quarters we were slightly short of launches. A lot of our launches are in the pipeline now, and I think in the second half of this year you will again see some very significant launches coming to the market in both the premium and the luxury segments. And I think the residential market, I mean, even if you look at the performance of the other listed players, I mean, the residential market, I think across the board and across geographies and across economic brackets, I think is doing very well. I mean, ironically, if at all, the one segment which I think is not growing with as much clip is possibly the lower end affordable, where potentially the mortgage loan rates, have had a higher impact than they've had at the upper end of the market. But otherwise, in the segments that we play in, the market has actually been extremely strong.
Good morning, Mr. Tyagi. So premium segment doing well, maybe some pain at the lower end. Putting all this into perspective, I just want to ask you for the year. Number, I think you as well have hinted that that's gettable in the past. And also the rental revenue, I think it was, the target was around 5,000 crores. Can you outbeat that number as well?
Okay. So, Nigel, 2 things. One, on if you look at our analyst presentation of June end, we had an opening inventory of about 5,000 odd crores, which was by inventory, I don't necessarily mean finished goods. I mean inventory of projects which had been launched. And we have a new launch pipeline during the year of almost 20,000 crores. So we will have a total availability of almost 25,000 crores of products to sell. We are assuming that somewhere what our guidance has been is about 13,000 for the year. But obviously, as the Q3 and Q4 launches happen, and if they do meet with a more enthusiastic response, like in the case of Arbor last year, I mean, these numbers could have an upside risk, if you will. But our official guidance stays at 13,000 crores, which is what we have told the market also. On the rental piece, the offices leasing, which had actually, the vacancy levels, which had actually gone up to almost 15-16% at the peak of COVID, are now back to about 10%. There also, the number is slightly skewed because of the SEZ vacancies, which are higher than the non-SEZ vacancies. And I think there's no immediate short-term solution to the SEZ vacancies because everybody, I think the entire industry, including the listed REITs, are waiting for the government's DESH guidelines to be notified, which hopefully, should make it easier for SEZ units to be also used for non-SEZ purposes. So we are all waiting for that to happen. But I think overall, we are now at a 90% odd occupancy level. The occupancy level in the non-SEZ spaces are in the early 90s. The occupancy level in the SEZ spaces will be slightly short of that.
Okay, before we let you go, the main reason for which we invited you, right, your re-entry into the Mumbai market. And I understand that this is a hot market, it's picking up, but it's also a slightly saturated market. Not the Navi Mumbai area, but, the spaces where we live in. So wanted to understand from you, what is the saleable potential here? What's the revenue potential? And how do you plan to go about it, given that there is so much competition now?
Okay, so obviously there is competition. If you recall, we had one project in Mumbai in partnership with Shaparji and a local developer called Huptown, which for a variety of reasons never took off. So we had been on the lookout for a potentially like at least a moderate entry into Mumbai market if we found the right product. This particular project near Andheri is actually has potential of almost 2.5 to 3 million square feet of saleable area in the LOIs that exist, with a potential for an upside later on. So I mean, you guys know the pricing in that area far better than us, but we do believe that I think eventually this could be a significant amount of maybe a 6,000 to 7,000 crores of sales potential on the phase that is currently available, and potentially grow forward further add on. The first launch of this project should hopefully happen, I'd say within the next 9 months from today. And it should be about 900,000 to 1 million square feet of saleable area, which I think, will translate to whatever area carpet it translates to. And I think that should be hitting the market, hopefully before March, latest before June.
We wish you all the best, Mr. Tyagi. Thank you very much for joining us. And, we'd like to speak more about the Mumbai market on our next chat. Thank you indeed for joining us here on CNBC-TV18. Well, that's DLF for you. The market is down a little bit more. I mean, it was holding with about a 20-25 point cut. We're down about 60 points now. I mean, just look at the two names. The shipbuilders, Cochin is up 11% now. So there is some serious concerted buying going on there, and huge volumes, Cochin. And I think it's up 40% in 3 sessions. So just complete re-rating in 3 days flat. Garden Reach, I think, is up about 40-45% as well in these 3 sessions, today included. So this has been quite incredible, the run on these names. All right, let's just a bit in the market, but let's talk to the experts on what SEBI is proposing to do via its consultation paper. So SEBI is proposing reforms under 4 key segments as far as the delisting of companies, listed companies is concerned. I mean, the basic primary thrust seems to be to try and make it easier for companies to delist. So instead of the reverse book build process, which has been in some cases a bit of a thorn for companies trying to delist, SEBI is now proposing in the consultation paper that there could be a fixed priced option as well. So that's one of the many things which SEBI is proposing. We had this SEBI chairman at the last press conference, chairperson at the last press conference saying that she doesn't want Abhimanyus in the market, which basically means she doesn't want companies to be able to come to the market and not get out. I mean, if the companies do indeed want to get out via a delisting. Mr. Jayan Gupta is with us, former executive director at SEBI. We also have, he's also, of course, the managing director at Stakeholders Empowerment Services. Abhishek Dadu is partner at Khaitan and Company. Gentlemen, great to have both of you here. Appreciate your time here on CNBC-TV18. Mr. Gupta, if I can begin by asking you, this is a consultation paper. There'll be feedback sought and then rules will be published. But does this, I mean, if you've gone through this, does it make it easier, the process of delisting from a company perspective in a very big way?
A very good morning. So not only that I have gone through, because I was part of the subcommittee, so I know each and every aspect of it. See, the idea was very simply that SEBI had gone into the data of delisting offers and found that there could be situations where the market's expectation and the company's expectation were not meeting because of certain regulations, and companies were not able to do something better. So based on that, it was decided that why don't we allow a counter offer in a different manner? Because earlier counter offer was only possible if the price was not liked by the acquirer, but the 90% plus shares were tendered. So here was a situation where even 90% shares were not tendered, but there was a possibility of counter offer. The reason were two, because in an initial delisting offer, generally the shareholders were having such a high expectation that the company is desperate to delist, so they will pay any price. So sometimes, I would say sometimes some investors were bidding at irrational prices. You would have seen that some 20,000 rupees was also bid in some offer, something like this. So in order to bring both the expectations to the ground level and the practical level, it was thought that even if 90% has not been offered, but the promoter wants to give another chance, he should be allowed. But it was discussed that it should not be a free way, that even if 1% shares are tendered and it is allowed. So a via media was found where the table is given in the consultation paper that based on promoter shareholding and public shareholding, what is the minimum threshold that should have been reached. So this was one way, and then it is linked that what should be the price. Now the price, as it is, the floor price is there, but then it was thought that to bring some sort of a semblance to the process, let us calculate the volume weighted average of the bids that have already come. Now there, if it up to 90%, more than 90% has come, the calculation happens till 90%. If less than 90% has come, calculation happens at up to the entire bid that has been given. So this is one way where it is trying to facilitate. How much it will be successful, only the market and time will tell. And secondly, I would say that no regulations are final, because every time when a regulations are put to marketplace, then some irritants happen or some problem happens or some cheating happen, whatever, everything happens. So regulations will go through a reform every time. So
Mr.
it
Gupta,
is one more step towards making it easy.
Yeah. No, Mr. Gupta, does it shortchange investors? Because this is a process through which, there are some instances, absolutely agree with you, where there is, there are people bid irrationally, right? I mean, to try and force the company, and it just doesn't make sense. But was that found, as you said, I mean, a study was conducted, was that found predominantly to be the case? Because this was also, the reverse book bid was also a way for common shareholders, retail shareholders to find, to get, the maximum price available to them. And nothing wrong with that.
No, I agree. So what we are saying again, you understand that there is no shortchanging of the investor, because option is always available to the investor to whether to tender or not. There is no forced tendering. It is only up to 90%. So if the reverse book building, there was an option where the price was not given. It was only the floor price. So investor had put bid at any price. Now the next counter offer is coming where there is a price which has been discovered based on the demand and supply position in the first offer, relisting offer. Even there, the investor will still have an option whether to tender or not. So it is not a force. Yes, it is only after 90% is reached. Then there will be a situation where either investor tender at that price or remain a shareholder in the listed price. Again, I am saying,
got it.
And Abhishek will agree that there will be people in the market, there will be bankers in the market, there will be lawyers in the market who will try to suggest 100 different methods to the promoters to do something. If anything is noticed by SEBI, SEBI will certainly take a further corrective action and do further reform. So the idea is that neither side should be suffering. So there was a situation where one thought that promoters were not having various options. There was only one option. This is one more option. Keeping
Yes, got it.
the right of shareholder intact.
Got it. So let's put this to Abhishek. Abhishek, your thoughts in addition to what has already been stated by Mr. Gupta, and I wanted to just also touch upon the what this would mean for, say, holding companies, because there is a special bit in the consultation paper for holding companies and how they can go ahead and delist, right? And I'm putting that out because these holding companies usually trade at a big discount, relative to the value of the investments that they own in listed or unlisted securities. Go on, Abhishek.
Thank you so much for having me, first of all. And I fully agree with Mr. Gupta. I think the fixed price delisting is bound to be a game changer in the current market. We've seen historically that the reverse book build, while it's a more democratic process, it ultimately tends to failure in the delisting because of unrealistic price expectations. So a fixed price delisting is bound to streamline the market a lot more. And like the SEBI chairman said, right, the option for you to come into the market should come with the option for you to exit the market. And that needs to be a realistic option. It shouldn't be one where you are effectively held at mercy by certain shareholders. Having said that, on the holding companies, again, I think it's a really progressive move by SEBI. Like you rightly said, the holding companies usually trade at a substantial discount because there is no a perfect way to value the underlying securities. And the long-term objective is that these shares will be held by the holding companies. So a solution that SEBI has come up with there is to say that we don't follow the regular process, not of a reverse book build, nor of a fixed price delisting, because neither of these are bound to satisfy the public shareholders in a true price discovery method. Instead, they have proposed a method where the holding company is effectively able to pass on the underlying listed shares to the public shareholders, as well as the benefit of unlisted stock or real estate. It is quite common for a lot of these holding companies to not just have listed securities, but also have some amount of unlisted securities or real estate assets. So those can be monetized in the form of cash, and that is passed on to the public. And then the delisting effectively takes place by way of an NCLT order, which is a tribunal process. So that makes the process a lot more streamlined in a way and enables a true exit.
Abhishek, just 30 seconds. You must have gotten a sense of feedback from companies and the ecosystem which works with corporates on matters like this. I mean, is the feedback positive? Just
it's very positive.
A straw poll.
I must tell you, this is something that the industry has been trying to battle for a very long time.
Yeah.
It's a wonderful move. We are all looking forward to it coming into play, and I'm sure it's going to be immensely helpful for the whole industry, no doubt about it.
All right. Well, so it does simplify quite a bit from a corporate perspective, but we will get to hear, and the feedback comes into the consultation paper from others as well. I mean, shareholder associations, etc. Thanks very much, Mr. Gupta and Abhishek, for joining in. Great to speak with both of you here, and good chat. Thank you. Well, 80 points lower on the Nifty is what we have, so it's a bit of a reverse kind of reaction as compared to the previous 2 days. So the market at open did not correct too much. We were down just 20-30 points, but progressively we've come off. So holding at the just under the 19,400 mark, almost the low point of the day. We'll take a quick commercial break here. Mitesh will be with us with some technical trading ideas. Stay tuned for that conversation.
Welcome back to the show. Well, for now, the market is down almost about 0.3%. Nothing major, but just kind of choppy. But the space to be in really is the mid-cap. So the mid-cap index is now at the high point of trade, up about 170 points. And a lot of big moves coming in, whether it's Cochin Shipyard, JM Financial, Coffee Day, DB Realty. A lot of the laggards are starting to move now in the markets. But let's get Mitesh Thakkar into the conversation. Mitesh, this is a very strange market. It's neither falling nor rising. It's sort of stuck in this range. But for now, when this consolidation phase continues, what do you do with individual names?
I think actually, that's the way to approach this market. Given the fact that it's a very choppy and now slowly narrowing market, I think you will not see much traction trading the limited. I think it's just on the verge of breaking into a fresh swing high. So buy above 122 here. Keep a stop at about 119.5. Look for a target of 130 to begin with. And the other one which I like is Titan. Disclaimer, we have recommended this to our clients. Titan is also on the verge of breaking out of a bullish pattern. The breakout happens about 30.60 to 30.65. So buy about 3065, keep a stop at about 30.30, and look for targets of around 31.45 to about 31.50 on the upside.
Mitesh, I know you have Mazgaon in your portfolio. I remember you telling us. But this Cochin Shipyard and Garden Reach, they've caught up in a very big way this week.
So, Prashant, I think a very strong move has started. I think, particularly for Cochin, the week, I think, and we still have today and tomorrow to go, 37% move has already happened. And the way this has pulled the medium and long-term indicators on the upward trajectory, I think the stocks will make, this stock will make at least a few more higher highs before cooling off. So my sense is that they should, on an extension-based target, I think, it could be anywhere between about 1,050 to 1,100 to begin with. And in a very bullish case scenario, even 1,200 could be tested for Cochin Shipyard. So very positive about it.
Okay, thanks a lot for that. So that's on Cochin Shipyard. But let's shift focus to the commodity markets now. Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Sonia, thank you. I'm looking at the crude oil prices, and good news clearly for India, as we are the major importers and consumers of crude as well. And we have seen the prices come off the way they were going up as well. So it's a fourth straight day of decline for the crude oil prices. We are trading at a 2-week lows, and 5% down in 1 week itself is how the prices seem to be really working with. There are a lot of factors which are weighing onto the markets right now. To begin with, it has to do with the dollar index, which has continued to gain for the last 4 weeks, and it's trading at a 6-week highs right now. Apart from that, it also has to do with the US Fed policy minutes that came in yesterday, which are signaling more rate hikes ahead, and that's weighed on across asset classes. The market's also looking at the Chinese economic numbers. All of that data and information coming in from China is weighing on. So the China Trust Fund says that they missed payments on investment products. So the real estate is an area where China continues to stay a laggard. But apart from that as well, whether it has been about home prices, trade data, investments, manufacturing, retail sales, every number that came out of China for the month of July on a month-on-month and year-on-year basis has been on the weaker side. And even as China has cut the key policy rates for the second time in 3 months, markets still are waiting for a big bang stimulus measure or some meaningful big stimulus measure to come in for the property there. Apart from that, the markets also are looking at the US production, which has continued to run up. The US production now at a 3-year highs of 12.7 million barrels per day. The market has been anticipating or estimating that 12.8 million barrels per day of an average is what you could see 2023 hit as well. Now, this is very close to the all-time high that we saw in 2020 at 13.1 million barrels per day. Not too far away from that, and that is what is bothering the street. So even as the OPEC and allies and Russia has been cutting output, with the US output increasing and near all-time highs, the all concern about tightness perhaps in this quarter and the next quarter seems to be easing away, and that's weighing onto the prices also. Is the reason, even as we saw the prices gain up all the way from $65 in the month of May to around 87 in the month of August, we seem to be just about holding 82 or 83 right now. So profit taking clearly coming in for this space.
All right, Manisha, thanks a lot for that. Well, moving on, sources to CNBC-TV18 indicate a very interesting development may be underway in the Indian footwear space. Which are the companies in focus? What would be the contours? Vivek is joining in with more details on that. Vivek, the stock Bata is up almost 1.5% right now. So take it away. What are you looking at?
Well, that's right. So what we understand from our sources, and like we mentioned, we understand that there's a strategic tie-up likely between two very large footwear companies. We understand that Bata India is right now currently in talks with Adidas, and we understand that there could be a strategic tie-up in the works over here. We also understand that this particular strategic tie-up would mainly be, focused towards the Indian market operations. We also understand that the talks between the two companies are currently in the final stages, and we understand that the final deal contours are right now being deliberated by both of the parties. We also have written to both Bata India as well as Adidas. Both of the companies have yet to respond to us, but we understand that one of the key factors behind this particular deal, or the rationale behind this particular deal, is that Adidas India would like to actually tap into Bata's very strong retail store footprint. Remember, Bata has a very strong network of almost 2,100 stores in India across 700 cities, and we understand this could be one of the key reasons for this particular strategic tie-up. We are still awaiting clarification from both of the companies.
All right, Vivek, thanks very much for that. And you can see the stock there, 1665 or so. That's an interesting bit of information which is coming through. More on this later. We'll take a quick commercial break here. Our special segment is the economy with Lata coming up in a bit. We have Kamaksha Trivedi, head of global forex at Goldman Sachs, speak about the churn in global currencies and inflationary trends in India as well. Stay tuned.
Welcome to It's the Economy. US yields and the dollar have seen a sharp U-turn in the past 2-3 weeks. The dollar index, after touching a low of 99 mid-July, has surged to around 103, while US 10-year Treasury yields have shot up from 3.5% in June to 3.7% in July to 4.2% in the latest week of August. In part, this is due to the producer price inflation number still remaining high for July. On the other hand, in Asia, in the EMs, we see a steep fall in the renminbi because of problems in the property sector. In short, currencies and fixed income everywhere are in a churn. To understand trends and factors in EM currencies and rates, I have with me perhaps the best in the business, Kamaksha Trivedi, the head of Global FX Rates and EM Strategy at Goldman Sachs. Kamaksha, thank you very much indeed for joining us. Well, first up, if you can draw up what's happening with the dollar and US yields. Yes, the producer price index came in slightly higher than expected, but such a sharp rise in yields?
First of all, Lata, it's great to be back on your show again. You're absolutely right. The dollar has been on a firming trend over the last couple of weeks. I think that reflects not just the firm producer price index, but also just overall, firm growth data out of the U.S. You're generally seeing U.S. activity track at pretty good levels for the third quarter after recording some pretty strong numbers also in the second quarter. But as you know, currencies are a relative game. It's not just what is going on in the US that's important, but it's also what's going on in the rest of the world that's important. And here we are seeing across some of the major economies, what I would call sort of the challenger currencies, say, to the US, developments that also have been in favor of a somewhat firmer dollar. The ECB in Europe has indicated that they are nearly at the end of their hiking cycle. Inflation is coming down there as well. We've had actually some tightening steps from the Bank of England and the Bank of Japan, but they have been somewhat half-hearted, somewhat spread out relative to market expectations of a more forceful response.
But what should we take away for a country like India? You see a firming DXY and you see a falling renminbi, a very steeply falling renminbi. How would Indian policymakers respond? They are worried about the trade deficit with China as well. So what would your range be for the Indian currency?
Look, we've described the Indian rupee as a port in a storm. I mean, the Indian rupee, you have a policy set up that is tries to maintain a relatively stable rupee. You have sort of the policymakers leaning on both sides of the currency to kind of prevent too much two-sided volatility. And reflecting that, what you tend to see is relative to India's yields or carry, as we call it in FX markets, and the volatility is extremely low. So from a carry to vol standpoint, the Indian rupee is actually quite an attractive currency and attractive diversifier in global emerging market FX portfolios. It tends to do well and outperform other emerging market currencies, in fact, in periods when the dollar is on the front foot, a period that we've just had. So even as it depreciates versus the dollar, it depreciates much less than other emerging market currencies, which is quite a nice thing to have as part of an emerging market carry or yield earning portfolio. So our expectations are that the rupee basically remains fairly stable. By the year end, we have the rupee, our 6-month forecast is around 82. We are close to 83 and change right now. That seems to me to be about right. We have a sort of broader view that the dollar is only on a very shallow depreciation trend for the reasons that we just discussed. And in line with that, we think the rupee strengthens a touch, but broadly speaking, fairly stable between now and year end.
There is also the allied problem of Fitch kind of challenging the health of US banks. Neil Kashkari, the Minneapolis Fed president, has also been asking for more capital. Both the instability, or rather the jitters in the banking space in the US, as well as rising yields, can this have some ramifications on emerging markets? If yes, what?
Look, when you have rising treasury yields, with treasuries being the sort of, if you like, the sort of key discount rate for global asset prices, especially when they are rapid, and you had a relatively rapid move in yields, that is going to have an impact on emerging market assets. It's going to have an impact on almost every risky asset across the world. This is sort of, if you like, the global discount rate. So I don't think we should be too surprised to find that as you've seen this kind of very rapid move in US 10-year yields up to something like 420, that there is a period of digestion, or rather indigestion, across emerging market assets, including, emerging market currencies, equities, and so on. But we are skeptical that this rising yields has much further to go. We think that rates are roughly in the right sort of postcode. Rates are likely to remain higher for longer, but inflation is cooling down in the US. The Fed is close to or is done in terms of its sort of hiking cycle. And that should eventually reduce rate volatility, which is one of those things that should anchor long-term rates. So not a huge disagreement with where the level of long-term yields is we thought it traded a bit too low on the when it was lower than 4%. It's probably on the high side of that now, but I'm not sure. At least we don't agree with the notion that it should be on a run higher from here.
Okay, so your range for the US 10-year, for instance, the yield would be what for the next few months?
We think it should trade around 4%. I think that's roughly the right sort of postcode for US 10-year yields. We were a bit below that for a while. We're now a bit above that. But we think that's roughly the level that we think is the appropriate one.
You did say earlier in the conversation that one reason for the rise in rates is the fairly strong data that's coming out of the US economy, the latest retail sales included. Do you therefore, can you rule out another rate hike? What's the Goldman Sachs view?
Look, I would never rule it out. I think that, it depends on a range of factors and a range of data, and that's something that, Fed speakers, point to as well. It's more that, we think the next, meeting, and a couple of meetings are some time away. The Fed has talked about a slower pace of hikes. That probably means that, the September is live, but not really live. And then you get to the November meeting, by which time you have another couple of CPI releases, inflation releases. And we think, broadly speaking, all of those inflation releases are likely to point to a slowing inflation trajectory that is likely to confirm to Fed officials that their job is more or less done. Is it possible that they hike one more time? Sure, it's possible. I think that, but one has to remember that we came from a period where the Fed was hiking 75 basis points a clip for 3 or 4 successive meetings.
Right.
If we now move to a pace where it's 25 basis points a quarter, that should still be consistent with a lowering of interest rate volatility, which, as I said, should act as an anchor for long-term rates.
Okay. I'm veering around to asking you how fund flow smart money will move and will it move towards EMs. But before that question, just a word on Indian rates. We had a fairly ugly July inflation number, but it was largely food. And then you have, as you said, a US, the global discount rate likely to be 4% plus. So do you think there is still upward pressure on on Indian yields?
Yeah, as you mentioned, I think it was a pretty ugly inflation release, but inflation driven by some very specific factors, food prices in particular. Those that may be specific. It's still a pretty painful part of the inflation data set, especially in a country such as India. And I think that the initial numbers that August has shown don't quite show a sort of meaningful drop off yet. So it's really, we're probably looking into the fourth quarter for a real move down again from some of these sort of unusual factors to do with food prices. So I think the hawkish hold that we got from the RBI seems appropriate. Again, is there a risk that they may have to do something more in Q4? It's possible, but again, I think that will depend not just on what is going on in food prices, but if that food price increase turns out to be more persistent, and actually if it generalizes beyond food prices, I think that's the kind of thing that will give the RBI a cause for concern and potential for more hikes. It's not what we expect. We expect inflation to decline, but on a slightly more slower path than before, given the upside surprise that we saw last month.
Yeah, I did see the Goldman Sachs report. Core inflation has come in lower, so that's not a big worry. But how do you see fund flows? Given that the US rate yields are likely to stay 4% plus, which is your base case, do you think flows to EMs, specifically to India, will be a trickle if at best?
I think that you're right, that I think we are in a world where the US economy is still doing pretty well, and the yield on US assets is pretty high when it comes to fixed income, but also the US equity market has been performing very strongly, in particular a number of tech-related equities that are benefiting from some of this artificial intelligence optimism. And so it's correct that you're seeing, fund flows move towards the rest of the world, but at a very, very, anemic pace, whether it's emerging markets or even other developed markets. And it's part of the reason why we've always felt throughout this year that the dollar decline would only be shallow, that for a much faster dollar decline that would be consistent with the Fed, finally ending its hiking cycle, would also require, much more aggressive fund flows into the rest of the world, which in turn would require, much more optimistic prospects for both yields and for, risky asset returns in the rest of the world. We're not there yet, which is why we think some dollar depreciation over the course of the year was appropriate, but it would be very shallow. And I think that speaks to your point about fund flows. When it comes to emerging markets in particular, however, and India, as you asked about, I think it's also fair to say that there may be some spillover, and a positive spillover, from what is going on in China. If you think about the last couple of years, a lot of the flows that went into emerging markets, a lot of that went into China and Chinese fixed income. To the extent that there is, more skepticism about that, and you're seeing more limited flows going into China, some of those flows may come into the other broader emerging market complex, and India may be one of the beneficiaries of that.
Okay, Kamakshi, I'll leave it at that. Out of time. Thank you very much. Pleasure having you with us on the channel. So the key takeaways: positive for Indian years for sure. A glass half full. An inflation trajectory that should be getting lower, and the rupee absolutely ranged and steady. That's good to hear. With that, we wind up on this conversation on Bazaar. Up next is Chartbusters after a break.